So, good evening, everyone. We all know budget was announced last Tuesday, and I'm sure many of have been hearing terms like changes in CGT, negative gearing, changes in trust, and today we are going to discuss about these. Now, after budget, there are two types of people. One who takes time to understand what's changing and they will adjust their strategy. The other who will wait, they will listen to others and they will follow the crowd. Today's webinar is about making sure you are in the first category, and we will try to share as much as we can because in today's webinar, we have accountant, Mr. Ankur. We got a broker, Kiran, and of course, few buyers agent, Dinesh and myself. The accountant will explain the new changes around announced in budget. The broker will share impact on borrowing, and the buyer's agent, Dinesh and myself, will share some strategies which can help you out to stay in the game. As in the past, our registration has always been heavy, and same thing has happened this time. This webinar was planned just after our last webinar, which was on 15th of May, and we got the registration close to 500. That clearly indicates there are many people who are looking for clarity. So before we begin, Dinesh, can you move to the next slide, please? So before we begin, some housekeeping rules. This webinar is being recorded and the recording will be shared afterwards. So please keep an eye on our social media channels like Facebook page. There might be a possibility we will send an email. Please stay on mute when speakers are presenting. We will have a Q&A at the end, but feel free to drop your question in the chat box. And my last request, let's ask the questions which are relevant to the topic. In case if there's any personalized questions like what is going to happen in this my scenario, we are always there. Please reach out outside of this particular webinar. Let's try to ask those questions which can help the wider audience. Right? Dinesh, can you move to the next slide? As I mentioned, this webinar is going to be presented by multiple professionals and the people who have registered for the first time. Let's start with a small introduction so they can know who we are. So I will begin my introduction. I'm one of the directors at Prop Expert and also a buyer's agent. I have been in this country since 2004. I started my property investment journey back in 2009. I bought my first house, which I just bought a land and built up. And the reason was I was to take the first home grant. So far, I have been investing heavily in real estate, which means I have multiple properties in residential, few in commercial. I've been, I would say, acreage as well. I've been also involved in development projects. As a buyer's agent, my focus is always to understand each client situation and guide them with the right strategy. With Prop Expert, so far, I've been involved in more than 300 transactions, which is across multiple markets by looking the client portfolios. That's all about me. Next is Dinesh. Dinesh, can I ask you to introduce?
So, yes, more like around 20 years experience. Mine is not that much. I jumped into this industry roughly 4 years ago and been investing for almost 6 years. So in my short period of 6 years, bought properties in 4 different states. I'm holding 9 properties and most of my properties are either a trust structure or SMSF. So I've structured my portfolio very well. And that's what, with these budget changes, my portfolio is not having much impact just because we structured from the beginning very well. And that's with most of our clients, when those who have bought 8, 9, 10 properties with us, they have structured very well. So we're going to be very focused today on structures. As Manish said, we both are partners in Prop Experts. We have served around like close to 300 clients, 400 plus purchases all over Australia. So we are very data driven by agency. So that's a bit about myself, right? I'll pass on that to introduce Ankur.
Hi everyone. Yes, my name is Ankur, and yes, I've been in the country for over 23 years, and I started my career back in 2006, focusing mainly in the self-managed super. So my journey has been reversed. So most of the accountants that do individual companies and super, and I've done in the reverse order. So I hold specialization in SMSF and also specialist accreditation. Over the last many years, I have presented in many forums and even at MCG to other 200 accountants and planners. I'm a registered tax agent and I have passion for property as well. In the last 23 years being here, I think the last budget was the only one that I've sat down and listened carefully. Usually I just check in the morning what's the changes, and then okay, yeah, but I think it's got everyone. So yeah, happy to be here, and we'll be talking about some changes through the budget from the tax side of things. So I'll pass it on to Kiran.
Good evening, everyone. My name is 𝐀𝐜𝐜𝐬𝐬, and I have been in Australia for 19 years. I wasn't planning to say that, but since everyone mentioned, I thought I'll say that as well. 19 in Australia, and I have been running deals for loans for the last 10 years. We are a team of 12 people, 6 mortgage brokers, 6 admin team, 6 mortgage brokers. They bring their own skill set. They all got past experience. They've all worked in the banks, approving your files, and now they're with us, making sure we're helping you guys. I actually personally own a healthy portfolio of properties myself that varies from under my name, under trust name, under unit trust name, under superannuation. And I understand how everything works, and that's from commercial to residential, all of it. Why I became a mortgage broker? I have a lot of passion for property myself, and when people talk about property, it basically gets me to the point, yes, I cannot stop talking about it. Hence, I am a mortgage broker, and I personally enjoy people saying growing their property portfolio. And I'm also really happy to see that all of people who joined today are actually learning. So as us, as mortgage broker, accountant, and buyer's agent, we are also learning all those changes that's coming. Hence, all of us together in the room, and I think let's just kick on.
So, disclaimer, that's very important. And as we have saw, we are a group of professionals over here, broker, accountant, buyer's agent. We can have our own views and understanding. So I would like to share a quick disclaimer. The full disclaimer is on the screen, but just to save on time, I will keep it short. This webinar is for general information only and does not provide any financial, legal, property, tax, or accounting advice. Please speak to a qualified professional before you make any decisions. I think I have also done some boring part. Let's start from Ankur and hear about the changes in the budget. Ankur, all over to you.
Okay. All right. So I think I see there's nearly 150 attendees here. So if you guys want to go and to the section where you keep the Panadol and multivitamin, so you might want to grab 2 Panadols, and because you might get headaches halfway through going through these changes. Jokes aside, yes, it is a big change in the budget, as everyone knows, and I think everyone was nervous. Manish nearly didn't sleep for a week. As you can see in the PFA, he was posting every second and minute, asking others how they're going, but I think it was more likely he was more nervous than anyone else. So I'll be going through some of the key changes tonight, starting from negative gearing, which is a big one, followed by the capital gains tax implications that government has brought in, and they all will be around the property. So we'll be focusing on properties today. If we go in the wider asset class, I think we can be here till midnight. And also the trust, which is another big one that the government has brought in, and that's a big change to the tax system. And I'll touch on a couple of individual and small business tax incentives. So, but we'll be mainly focusing on the negative gearing capital gains tax. Next slide, please. Okay, so what's changing? So I think everyone probably have a bit of idea what negative gearing is, but in a summary, so it's basically the losses from the investments. So, we have, let's say for the property, we have more expenses than the income. So that loss that results is called negative gearing, and that we offset against our other income, whether it's a salary and wage or dividends or any other income in the tax return. That saves us tax. So that's what's been happening, for decades. What government now done is they're trying to put a stop on these negative gearing or minimize these tax benefits to the people. So hence, from 1 July 2027, the negative gearing will be sort of disallowed. In some cases, it's allowed. So I'll go through those later through my slides. So basically, that means is negative gearing, you cannot offset the losses against your income, means less tax benefits. So what's happening from 1 July 2027? So I'll break down the scenarios in a couple of ways that can happen, and that will explain how we're going to go forward with these changes. So the first one is established rental properties held before budget night. So which means if the contract was signed and settled before 7:30 p.m. on 12th of May 2026, those properties are grandfathered. So if someone has signed a contract, let's say on 11th of May, and it's an investment property, business as usual. So you have negative gearing from either depreciation or interest or whatever, you can still continue to offset those deductions against your income. So this one is pretty clear. The second possibility could be the contract was signed before 7:30 p.m. but hasn't settled, but settled after that date. So let's say again, 11th of May, someone goes and buy the property, sign the contract, but the settlement is say in July or even say today. So those properties will also be grandfathered because the key thing here is the contract date. So if the contract was signed before 12th of May, 7:30 p.m., those properties are grandfathered. So whoever has bought investment property before that date, there's nothing to worry about, business as usual. Okay, then the second part to that is if we have established rental properties purchased after the budget night. So let's say it's now we purchase a property after the 12th of May 2026. And if the property is purchased after the 12th of May 2026 until 30 June 2027. So remember, the changes are coming from 1 July 2027. So that means there's still one financial year in between now until 30 June 2027. So let's say I go buy a property today and that settles next month. That property still can be negatively geared, but only up till 30 June 2027. So that means the negative gearing is available only for 1 year. After that date, that property will no longer be available for negative gearing. The losses, you can still have the negative gearing for that property, but the losses have to be deferred until the property becomes positively geared. So in a short example, let's say we have $10,000 loss on a property for year one, 8,000 the next year, 7,000 the year after, and then it becomes positively geared. So those $25,000 accumulated losses over the last 3 years can be offset against the future rental income. So we can't say it's a complete waste, or we're not going to get the benefits. To me, the benefits are now deferred, and that means people will have to hold properties a bit longer until they become positively geared to get the benefits in the longer term.
Good question, Anku, here. So what we have is the losses carry forward. It's pretty much similar what we see in a trust structures as well, that every loss is trapped within the trust. Is that something to say?
Yep.
And other question is, if I'm owning an investment property, say 10 years ago, I bought one property which is positive cash flow now, right? And I bought another property which is negative cash flow going forward. Can I offset my profits from other investment property with this one?
Look, there is no clarity from the government at this stage, but I think they will have to be quarantined. So we probably won't be able to offset the loss of one property against the other one, unless I haven't got it right. But I think that's what my understanding is.
Okay, makes sense.
And the last one is if the established rental property purchased on or after 1 July 2027, then that property will be under the new rules. That means the negative gearing will have to be accumulated until we get the positive income, and then we can offset those carry forward losses. Again, similar to what Dinesh said, in the family trust, this is a typical scenario where the trust is in loss, but loss cannot be distributed to beneficiaries, and then when the trust becomes positive, we can offset those losses, and then beneficiaries will start paying tax on it. Next slide, please. Okay, so this was for established properties, but let's talk about newly built, because the legislation does say that the whole fundamental behind this is the government wants to increase the supply of new homes. So to keeping in mind, all these changes sort of revolves around that principle. So hence what they said is, okay, you can't claim the negative gearing immediately on the established properties, but if you go buy a newly built property that increases the property supply in the market, then eligible new build properties, the negative gearing will be allowed instantly. So you don't have to accumulate losses. So if we have $20,000 loss from the newly built property that someone has purchased, you can claim the negative gearing as you would do as of today. Now, eligible new build, what does that mean? That means a newly constructed home. Or let's say you had a home and then you knock it down and then build a duplex. on that, because that also increases the supply of the house. So off the plan apartments, so they are also considered newly built home. And also, if you have a previously vacant land, so you could have a land in the established suburb where there was no house being built in the past, and you go construct a house on that vacant land that you hold it for last 10 years or 5 years, that is also allowed to claim negative gearing on. So even though the land was purchased ages ago, but because it's going to increase the supply of the dwellings in the market, so the government said you can claim negative gearing on that property.
Uncle, small question over here for the new build. If we got a land and the house has been constructed where the owner is living in that property for last 6 months, right? Will that be still classified as a new build or will be classified as established property?
Look, so far, again, we need to wait for the HO to provide a bit more clearance on that. But from my research, it says if you buy an established property or a new build property from a builder, and if it's less than 12 months old or occupied by the builder, they keep referring to the term builder. So I'm not too sure whether, if someone buys or build, let's say you go build a new property and you lived in it for 6 months and I buy a few. Now, does that qualify? I think we need to wait for the further clarity. But so far, wherever I read, they all referring to a builder building the house and then not occupying it for 12 months. For example, a display home could be an example where it's a new build, builder's been there, but if they had the display for over 12 months, that may not qualify.
Okay. And in terms of the knockdown, you mentioned about the knockdown where they can be 2 duplexes. What happens if someone knock it down and build up a bigger house?
I don't think so that will qualify, because that still doesn't, again, the concept is increase the supply of new housing. So if that doesn't increase because there was a house already there, now you're going to build a bigger house or even put a granny flat at the back. So that will not qualify.
Okay, thank you.
All right. So these rules are for the newly built residential properties and non-residential property and other assets purchased at any time. So commercial properties, shares, if you are borrowing to buy shares, and private investors supporting government housing programs. So these properties are actually exempt. So that means the investors who are looking to invest into commercial properties, the business is as usual. So they can still have negative gearing from those properties offsetting their income instantly, so they don't have to accumulate losses until the property becomes positive. So which I think is a good outcome for commercial investors. The entities which are exempt from the negative gearing changes are widely held trusts, which is mostly managed funds. So this is the entities where you have 300 plus unit holders, very rare to see, and superannuation funds. So this is another positive among all the negative that they did not touch self-managed super fund. So that means if you have a self-managed super fund, you could use negative gearing in the fund. So a lot of clients don't know that the negative gearing in the fund does exist. So without spending too much time on it, let's say the fund has rental income from the property they've got. There's interest deductions, there's depreciation, and on the income side, you also have your employer contributions. If all the rent and contributions minus the expenses, there's a negative income, so that's the negatively geared super fund, and they can use that negative losses to offset against the concessional contributions. So otherwise, let's say your balance is with Australian Super and your employer puts in $20,000 super for you every year in Australian Super. So Australian Super will take 15% tax on those contributions and pay to the ATO. If you have SMSF and you still have $20,000 contribution, but hang on, your super fund also resulted in $15,000 loss from the negatively geared property, that $15,000 loss can offset against the $20,000 contribution. So you only pay tax on $5,000. So they have not touched superannuation from that regard. So people who are buying or considering buying through self-managed super, that's a good positive outcome.
Yeah, see, is that something like, for example, I'm having a very high income, and particularly I sold my property. At that time, you contribute in the super, right? And your concession super contribution, and you can contribute for last 5 years. That's
Yes.
one way to reduce your income tax. Is that correct?
Yes, so the catch-up contribution, so if your balance as at last previous financial year at 30 June was under $500,000, then you can use catch-up provisions and you can make up for the contributions that you missed out in the previous years, and you can put it in 1 year to bring your taxable income down.
Right.
And in the fund, if you happen to have a negatively geared property, you can offset the losses. And literally, when I was talking to you this morning, I have this client who was in defined benefit, and we bought a property here in Donnybrook and had nearly $70,000 worth of accumulated tax losses because of depreciation interest that he was paying. But when he changed his employer and start contributing to the SMSF, and now he's only 3 years away from his retirement, he used his catch-up provisions and put nearly $60,000 worth of contributions and get away with zero tax. So he only paid $259 supervisory levy, and so good outcome.
For myself, like last year, what I've done is I had only 120K with my wife in a super. So I've contributed 200K, both 100 and 100, both of us, using last 5 years of contributions. We reduced our taxable income by 200K. Instead of paying 47% tax, I only paid 15% contribution tax. So I've reduced it. I've saved the money straight away there, and I'm active gearing those properties under my SMSF as well. Right? Good. That's good.
All right. Next slide, please. Okay, so that was the negative gearing. So I'll now talk about the capital gains tax. So this is another big change that they brought in. So as per previous rules, or as of now, the rules were that, if you have any asset that you've invested in, and provided you held it for more than 12 months, whatever gain you make, it was 50% CGT discount, and the balance you'll pay tax at your marginal rate. So the government is now looking to replace that 50% CGT discount by cost-based indexation, which basically, in other words, means adjustment of the cost as per the inflation. So, and then you compare that adjusted price to the sale price to work out your gain. So 50% is gone. The other change and I'll go through in detail on each of these. The other change is the minimum of 30% tax will be applicable to the capital gains. So this actually throws the opportunity out of the window where, husband and wife, they bought a property, they worked hard to pay it off, and then they thought, okay, we will sell it when we are in retirement phase or when we retire. So that means any gain we have, we will pay very less tax because we don't have any employment income at that time. So the government then now have brought in this 30% minimum tax of capital gain. That means doesn't matter how much your income is. If you make a gain, of course it will be adjusted to index, but then whatever the balance is left, there's a minimum of 30% tax to be paid on the gain. Basically,
back in the days when we had parents, so if we have a kids who's 18 years old having a tax brackets, we would able to distribute in the lower income family members, and save their whole marginal tax brackets, say 0 to 18,000, zero tax, things like that. But that is all gone. You have to pay 30% now minimum on all the distribution you do on there, right?
Yes, correct. So so it's similar to what you just touched on in the trust structure as well. So where minimum of 30% is applicable regardless of what else is happening otherwise.
Sounds good.
And then what they also brought on a positive note is investors who buy the new built properties, they will have a choice of either using the previous method of 50% capital gains discount, or work out the gain as per the new method. That means you index your cost base and then work out the 30% minimum tax on that on that property sale. So you can use either of those methods, whatever gives you the more benefits. So, and that's available to the new investors. The new build properties only. And if any asset, again, this changes from 1 July 2027. If there's any asset sold prior to 1 July 2027, that will be subject to the existing rules. So then they will get 50% discount and then pay the tax on the balance. So I'll go through that in detail in the next slide. Next slide, Dinesh, please. Okay, so the first scenario is when the asset is acquired before July 2027 and held for more than 12 months. So let's say someone's got an asset, they bought it in 2025 year, and they disposed before July 2027. As I said, if you bought before July 2027 and you sold it before 2027, old method applies, 50% discount, and then you pay tax on the balance of the gain. Now, the tricky situation is when you purchase the asset before July 2027 and you sell it after the July 2027. So this is a crossover period. So let's say I bought a property in 2024, then I go and sell it in 1 July 2028. So the HO says in those cases, you have to actually split your gain calculation into two parts. So your first part is from 1 July 2024, when I bought the property, to 30 June 2027, I will have to work out the market value of the property at 30 June 2027. So that becomes kind of like a deemed sale price. And then you work out the gain between my cost and that value that's been derived. And then whatever the gain is, 50% discount will be applied to that. Then from 1 July 2027, whatever the market value of the property at that time was, that becomes a cost base for the calculation up till the July 2028. So this is where it gets tricky, and I was saying take 2 Panadols because it gives headaches. Even sometimes when I read through it, then I'm like, hang on, how are they going to work it out? So basically, the HO said they will provide a formula how to calculate in the near future. Basically, we'll have to plug in the figures, and then magically we'll work it out. I think Dinesh, you probably have already done something on this.
Manish is working on that. We are building a tool in a website where we are putting a scenarios in there that if when we buying a property or when we are selling the property, what sort of capital gain differences will be there. So we are working on that. We will be touching base in the website. So how do you see, is there any clarity, Ankur, on how you value your property on 30th of June 27? Is it the independent
That
value or
was
you
my
have to
next question. Does everyone that means need to organize a valuation on that day?
Probably, yes, but then there's still the HO hasn't provided any written clarity. But yes, if you're in a property valuation business, then yes, there's a time to make money, I would say. Most likely, I think I wouldn't be surprised if the HO goes down the path of that the valuation needs to be from a registered property valuer, not just a appraisal from a local real estate agent, because they can write whatever you want them to write. I'm not saying
we are self-licensed real estate agents.
But yeah, so I think the further clarity onto that is yet to come, because they're not in a rush. It starts from 1 July 2027. They know if someone's going to sell from between now until July 2027, they're all under the old rules anyway. Oh, the big other thing which I forgot to put it on the slide is if someone has pre-CGT assets. So CGT came in September 1985, somewhere there, 20th September. So if you have a pre-CGT asset, that was always exempt from the tax. Doesn't matter when you sell it, because that's when the capital gains was introduced. Under the new rules, those assets will also be captured. So the government is saying when you bought the asset pre-CGT date to 30 June 2027, you work at the market value, and up to that period is exempt. Then if you hold the asset for, let's say, another further 10 years, you will be caught under that 30% minimum tax on pre-CGT assets as well. I haven't seen many people. Like last year, I did one return where he used to be actually my manager at Coles. He sold the asset which was pre-CGT, but but if someone does have pre-CGT asset, then I think those people might be offloading properties.
Hi, Donnie.
Sorry, go ahead, Ankur. It was just I missed that.
Okay, yeah. No, yeah, so that's I thought it's worth mentioning. Not applicable in all cases, but yeah, if you do have it, then you should probably think about when to sell or if to hold still. Yeah,
Next
so
slide.
that's right. Yeah, next slide, please.
Is the next one? Yeah.
Okay, so the previous slide was when the assets were acquired before July 2027. So this one I will talk about when the assets were acquired after July 2027 and held more than 12 months. So again, the 50% discount then doesn't apply because this will be caught under the new rules, and we will have to do the indexation with and calculate the tax with a minimum 30% tax will apply. This is a new one from 1 July 2027. Now 50% CGT. unless the new build exemption applies. So as I mentioned previously, if you did buy a new build property and when you sell it, you still have a choice of either using 50% discount or indexation. So that then still applies for those properties. Eligible new build residential properties, yes, as I touched, dispose on or after July 2027. So this is an interesting one. So if I say go and do a house and land package and I buy the property and I'm the first purchaser of the property, let's say in 2031, I need to sell the property. As I said, I have a choice of either using the 50% discount or 30% and indexation as a minimum between these two methods. But any subsequent purchaser who will buy my property, they will not have that 50% discount attached to that property. They will have to use only the 30% and indexation method because it stops after that property is sold to the subsequent buyer. So it's only available for the first purchaser. So yes, no CGT 50% discount available. Next slide, please. A few exemptions, which I think pretty much everyone already know. Main residence, they haven't touched that. So that principal place of residence continues to be exempt from CGT. There are a lot of questions. I think Treasury provided some guidance the other day saying if you convert your main residence into the investment property, then can that be negatively geared? And the answer is yes, because this was purchased before 12th of May. The budget night. So if you convert it into investment property, then that is still a negative gearing, can still be claimed for even your PPR. But again, then you will expose the PPR to the tax because it's now income producing asset. Then you should talk to your accountant because you still have 6-year exemption and various rules that interacts with that. Asset held by companies. So this is an interesting one. So companies never get capital gains discount. So, and that's why they are exempt because the companies never got CGT discount in the first place. So if I buy a house in the company for 400,000 and sell it for 600,000, that entire $200,000 gain is subject to 25% tax in the company. So hence, and this is where we might see people, their strategies, using companies more, but then the downside to me is, okay, yes, there is less tax in the company, but there's no indexation available. So if the property grows significantly higher in value, then even at 25%, you might end up paying more tax versus if you go with the indexation. But then there's 30% tax or outside the company. So it will depend on case-by-case basis, but I think trust will become less popular and maybe companies will become more popular. That's what I think.
Yeah. So what you're saying is the indexation method what we use for a trust, not trust purchase selling or the personal assets. The indexation is not available in the company. You are going to pay whatever profits you have made.
Yes.
Sale minus cost price.
Yeah.
Whatever into 25% is where you're gonna pay the tax straight away.
Correct. Yeah.
So in a layman words, we can say it like if you buy a property under a company, it's been considered as a business, right?
Yes, pretty much. Yes,
pretty much, right?
Just on the revenue account, you can say,
Correct.
that you just compare cost versus sale, and that's your profit, and you pay tax on it. But it might work out a good strategy in the long term when people in the trust where they have to cop 30% tax as a minimum regardless of the income. But if they sell an asset in the company and they retain the earnings and then pay dividend later on when they have less income, then they might get a better tax outcome. Again, as I said, it's so complex and everyone's situation will be different to other person. So there's no blanket rule saying, yep, go buy under company. Assets held by the super fund, including SMSF. So again, these are exempt in a way. It means that all rules apply. So super funds gets 33% 1/3 discount on the capital gains. If you have to work out in easy terms, the super fund pays 15% tax. So after the 1/3 discount, it basically means 10% tax on the gross gain. So, and I think SMSF between all the entities is kind of like a winner, where it is best for the tax structuring point of view. Yes, there's a downside because if you need the cash, you can't touch it until you retire, or if you pass away, then your dependents will get it. But the access to cash when required may not be possible in the SMSF. But if your plan is to hold the properties for long term, and then until retirement, you're not going to sell the property regardless whether you bought it under company, personal name, or super fund, then SMSF might become a popular choice going forward for some of the investor clients.
And if correct me if I'm wrong, if it goes to 0% if you're selling the property after the retirement age, is that correct?
Correct. But that's also now changed because the transfer balance cap reporting that they brought in a few years ago started with 1.6 million, currently sits at I think 2 or 2.1 million. That means if my property grows to $3 million when I'm gonna retire, the government the cap will keep getting indexed, but let's say it's 2 million at that time. Basically what the government is saying is you can only have up to $2 million in the pension phase. The $1 million will have to sit in accumulation phase. That means some part of the gain will be taxed. But again, if you look at companies or if you look at trust now with 30% minimum, personal with 30% minimum, superannuation funds will always be concessionally taxed. That means it doesn't matter what happens in other entities, you will have a better outcome in the SMSFs.
No, sounds good. That's good. That's great. Next slide.
Yes, that's right, please. Yeah. Okay, I've already, I think, spoke quite a bit about trust. So yes, so now from 1 July 2028, so for the trust it's not 2027, it's actually 1 July 2028, where the minimum 30% tax will be applicable on the trust distribution. If I have to put an example, let's say in the past people had the trust, and let's assume there's only a property in there, and mom and dad, they're working in IT sector, earning decent income. So what they used to do is distribute that income from the trust to, say, their parents and to adult children's. So because the distribution is, let's say, $10,000 to each, and up to 18,200, there's no tax. So hence they get away with zero tax. So the government thought this is a loophole in the system, so we're going to close it off by applying 30% as a minimum tax. So how it will work is, let's say my example, $40,000 is a trust distribution. The trustee of the trust will have to pay 30% tax to the government before the distribution can be made to the beneficiary. So that means $12,000 will have to be paid by the trust to the ATO, and all those 4 beneficiaries can claim that tax that's been paid to the ATO as a credit, but it's a non-refundable credit. So what it means is, let's say all the 4 beneficiaries, they have no income, and as I said, up to $18,000, there's no tax anyway. So that means the tax on $10,000 distribution that all 4 people got is zero. So that $3,000 tax, that 30% tax that the trust has paid initially, will become non-refundable. Versus if, let's say, this $10,000 is distributed to mum, who's high income earner, and then she's paying 47% tax to the ATO, then what she can do is, okay, she has to pay $4,700 tax on that $10,000 distribution, but because trust has paid 30% already on that distribution, so she can claim the full credit, but she still paid 47% in a way, because there's still 17% that needs to be paid by her.
Okay, so whoever the low tax earners in there, if you're distributing the income to them, there's no refund they can claim because the trust has already paid. If they're following, makes sense.
So it's kind of like just in other words, you can see it as a franking credit, which is non-refundable.
Yes.
So if you get BHP shares and there's a dividend, the franking credits comes refund, even if your income is, say, zero, because you get that back. But in this scenario, those credits will not be refundable. But people might still use it for high income earners where they say husband and wife still paying 47%. They're like, okay, yes, we know giving it to children, they're not going to get 30% back. But if we keep the 47, then we have to pay the top margin rate plus the Medicare. So maybe still better off, distribute to the children or the low-income earners, and then you get a better outcome, maybe slightly. But there's significant benefits that used to be present. There's now especially targeting those.
Makes sense.
Does franking credit still apply if bought under a company?
So
Sorry, Farhan, we're gonna take questions in the end. Like all other questions, we'll all take in the end, and we can answer them. Right?
And we got a lot to go, right? So
Yep.
Yeah. Awesome.
and Uncle, you were right. I'm also already thinking about Panadols.
I told you, you might need it before and after. Yes, and they're also saying that if the trust beneficiary is a corporate beneficiary, then those credits will not flow through to the corporate beneficiary. So, and then again, there's a bucket company scenario and all that. So there's lots still going through, and we're still working through a lot of those changes, how it's going to work, and there's still not clarity on everything that's out there. I think in a couple of months we'll probably know a bit more. And widely held trusts, complying super funds, disability trusts, deceased estate, charitable trusts are excluded. That means these trusts will not get taxed at 30%. So for them, the business is as usual. So like the SMSFs, they pay 15%. So they'll pay 15%. So there's no 30% tax imposed on those entities. Next slide, please. Okay, so just to touch base on few changes on the individual and business side, so I won't go in too much detail. There was a few others regarding R&D and some other changes. So from 2027-28 FY, everyone working Australian will get $250 tax offset. Yoo-hoo! That's going to make everyone rich. So, but I think it's going to stay permanently there. And then at the moment, what we can claim $300 without receipts, that will become $1,000 deduction from 2027 income tax year. So when you go see your accountant to do your 2026 tax return, please don't ask $1,000 back on top of your refund, because it's not a tax offset. It's actually going to be a deduction and applicable from 2027 FY. So it includes stuff like working from home, telephone, internet, and all that. But if you have other deductions or you want to use other method that will give you more than $1,000, then you can choose those. Payment to the tax agent fee, dividend deductions, donations, they can all be claimed on top of that 1,000. So whatever the 300 was previously, it now becomes 1,000, basically. That's just I think that's more sensible. Like, I think everyone spend more than $300 for work-related stuff. On the business side, from 1 July 2026, so next financial year, the $20,000 instant business asset write-off is available. So if you're a small business and you buy any asset which is $20,000 or less, you can claim the full amount as a straight deduction in your return. So which is, I think, going to help a lot of small businesses, where their assets are under 20 grand value. So I think that's pretty much it from me. As I said, it's not all doom and gloom. We had COVID and the whole world comes to stop, but somehow we, found our ways, and, everything is up and running in a different form and shape. Working from home was never there. Now it's a new way of doing things. We're doing this webinar. This could have been in a, Park Hyatt or somewhere if the COVID wasn't there. So I think there's nothing to be upset about. Yes, there's going to be more tax, but, me as an accountant, and I also have 4 properties, I'll be more focused on growth of the properties, because if I make $1 million, I don't mind paying a bit of tax. But the structure, which one will work for me, that all depends on, I think, everyone's circumstances. And Kiran and Manish and Dinesh will go through a bit later on this topic as well. So yes, thank you for listening to me, and I'll pass it on to the next presenter.
Thank you, Ankur. I think what you have covered, you will have so many questions in the end anyway, so you have to stick around. But great presentation. We are going to look at the next one, Maniji. Anything?
I was about to say to Anku, there has been a lot of questions which has came in the chat group. I have tried to answer, but given I'm not an accountant, I'm not able to answer all of them. We're going to pass it to Kiran, but on the spare time, have a water and then have a look at the question, please.
One thing I will mention, I think this is a good question which I forgot to touch on. Will there be a loss offset against the profits made through rental income or even capital gains too? So the answer is yes. So if you have accumulated negative gearing losses and then you happen to sell the property, you actually can offset those losses against the capital gain. So generally, this is against the ATO's tax principles, where the revenue losses usually offsets the revenue income, or capital gains can be offset against capital losses. In this case, the accumulated revenue loss of negative gearing can be offset against capital gains.
So basically,
Thank
I
you.
would say it's a delayed benefit instead
Correct.
of every year benefit.
Yes.
Basically, it's
Yep.
not gone anywhere. It's just instead of having it every year in your account, it's going to be considered later in the stage.
Correct.
If you sell, if the property go positive cash flow in both scenarios, you'll get it back.
Yes, because if you buy a good property and then let's say the LVR is 80%, basically for those mom and dad investors, the negative gearing was probably coming because of the depreciation. So that means your cash flow is not impacted. So you were getting benefits of negative gearing, but your cash flow all covered. So now if I have to accumulate the depreciation for the next 3, 4, 5 years until my property becomes more positive because the interest deductions are lowered, that's just a delayed benefit, as you said. So it's not like I'm going to be out of pocket. It's just the timing.
Yeah. Okay.
Cool. I think we might be running out of time, and we still have to cover a lot. Let's pass on to Karen. I think she's very excited to share about the landings.
Phew, I'm excited to cover my part, but oh my God, Kur. I'll get straight onto it since we haven't got much time left. Today, we've already spoken about all the budget announcements. So let's take a look at how it is looking for the people who's already have the approvals or looking at the approvals, or what the servicing is going to look like. Also, as we all know, that established properties will now be affected differently when we do the serviceability for each client. In terms of policies, there's a lot to discover. Policies are still evolving. Banks themselves are not able to answer many questions. What's going to happen, how they are looking at it, whether to increase the borrowing capacity, they're going to maybe slightly reduce the buffer, or so many different things has been in the conversation over the past week. But let's get on to the next one, Dinesh, and look at some of the things. Many of you may have already pre-approved applications. So let's say if you have already purchased the property and your loan has been unconditional, there is no reassessment required. It will stand as it is. If you got the full approval, even after the 12th of May or yesterday or today, nothing will change for you. Your full approval stands. Now, if it's a conditional approval, if you planned that you were going to buy a property, but the property has not been purchased, or if you purchased the property yesterday, there are high chances that your loan will be reassessed again. So one suggestion here is, in the past, we used to say, no worries, get an unconditional offer ready to go. Make sure everybody has subject to finance when we are making offers, or a definite conversation with the broker beforehand, because if you're in a high income, if you're a high income earner, then that might not be a problem for you, but it's a good idea to get that. Anything after the 12th of May, the latest policy update will apply. What is the latest policy update? There is none, basically, from any of the lenders. There are only 2 lenders, Macquarie and Westpac Group, who have announced that they're gonna take the negative gearing as it goes, as it's announced. However, there is no other policy updates. Any contract that was signed before 12th of May 2026, it's business as usual. Even if you have not done the loan application, don't have the pre-approval, none of the new rules will apply to you. It will be whatever the future rules or today's rules. Thanks, Nish.
Yeah, just a quick question. I'm not sure if you're covering it. So if, for example, any personal borrowing, what we assess, right? So negative gearing is added back into the servicing, and they get a better servicing by that time. Like now when this is chopped, right? Anyone going to buy properties now, what sort of impact you can see on the borrowing? Is it any percentage, any sort of figure we have at the moment?
Initial conversation with the banks, they're looking at slashing about 25%.
Okay. Okay.
But I am
Uh,
covering some of the part how we recover from
Right.
that.
And those who are initially started to plan to buy a property in a trust structure or kind of in
No change
equity,
for them. No change for them.
because they are not considering negative gearing anyways in their
Correct.
assessments.
Correct. So if the pre-approvals under the trusts, there's no change for you. But though be mindful, there are a couple of banks who let us add the negative gearing back. So just ways of doing the serviceability. But as a general rule, no changes. If you're buying under the trust, your borrowing capacity should be same what it was last week or today.
Makes sense. Next slide.
Yep. Thank you. Over the last 10 days or so, these are the questions being asked, which I think are general question for all of you. Should I buy now? Or what could change over the coming times? And to be honest, 2 years ago, 1 year ago, 6 months ago, everybody has asked this question, should I buy now? And answer's always been yes. Will my borrowing capacity reduce? What's happening to refinancing? Should I restructure or should I hold my current structure, or is SMSF a better way? In the nutshell, I'm only going to say do not take any panic decisions, because I think there was one day I received over like 60 calls because people are panicked. So don't panic, hold on, wait, and let's see what's happening before we make any changes. Next slide, Dinesh. There are some ways we can look at how we increase the future borrowing capacity. Dinesh has already mentioned that when we talk about the trust, there are no changes. If you are planning to buy under the trust, you've already opened the trust, created the trust, you want to buy that, no changes for you. Your borrowing capacity will stand if you have already got it checked. If you haven't, happy to do that. Some ways how we can increase the borrowing capacity: review your existing interest rates. If, let's say, you hold 3 to 4 properties and we can get your interest rate down by only 0.1, 0.2, that is now going to make a lot of difference on your borrowing capacity. Increase your loan term. If you're someone like Manishji who's been doing this for the last 10 years, the loan term might be 20 years now. Maybe it is the time to bring it back to 30 years and increase your borrowing capacity. Stick more with P&I options. If you may or may not know, if the loan is principal and interest, your borrowing capacity is always better than the interest only. Yes, I understand sometimes we need to give some thoughts around the cash flow. However, let's say if you had 3 or 4 properties, all interest only, if cash flow is not a problem, putting them all in P&I will increase your borrowing capacity as well. The last one is focus on the higher rental yield. This is now more important, that your rental is better than if you not thought about it in the past. Next one, please. We are all looking and talking about SMSF. Yes, it is definitely looking bright. There has been many conversations where we said, should we borrow at 90% or should we not borrow at 90%? And an accountant sitting here might not agree with me, but for the loan perspective, for the lending perspective, if you do have 10% deposit, it is a possible. I've just put a live example here from someone that we got a pre-approval yesterday. This client is particularly looking around Ascendon area. Let me say that postcode restrictions do apply when you go to 90% under the superannuation. They wanted to buy a property for 550, loan amount 490. And obviously the first question come in, if we're borrowing so high, are we going to pay LMI? Are we going to pay a risk fee? No, in this situation, there is no LMI, there's no risk fee. Though if you look at the interest rate, it is 8.45%. There is additional 1% buffer in the interest rate. But if you look at this loan amount, you're only going to pay this interest maybe, I don't know, for 6, 12 or 24 months, depending upon how soon your property grow. If your property grow, it will be refinanced back to a normal loan and your interest rate will come down. I've also added some of the expenses that are looking at what it is going to look at. But I will say, with everything becoming tight for some of the people, even if you've got the lower SMSF balance in your super, you can still invest, you can still look at the opportunities from this side.
Yeah, just another disclaimer. Just consult with the right professionals or financial planner, accountant before making SMSF decisions. But
absolutely,
from here, what I can see is if I'm looking to buy a 500 or 600K property, I only need like 100, 110K for the whole property purchase. Is there a buffer required in this case, Kiran?
Not for this particular lender, but there might be lenders, but at 90%, no. This is the reason why they're going at 90% because they haven't got money.
Yes. Okay. So there's no buffer required. So literally, you're buying a 600K property, it's a 60,000 deposit plus maybe stamp duty of 25, 30,000. If you're hiring a buyer agent, say 15,000 on top, all the miscellaneous costs, say 5,000. So literally 600K property within 110K balance, you can still buy a property under SMSF, right?
Correct. This particular client only had 95K in super.
Yeah, that's great. Another question here is when you refinance in the future, say down 2 years down the line, my 500K property becomes 600K, where your LVR is now down. In SMSF, you can't really refinance, take a cash out. It's all going to be dollar to dollar refinance.
Correct.
And only benefit you have is your LVR goes down from there 90% to 80 or 75. From
Your
there, you get a
interest
better
rate.
rate. You get a
Yes,
better
your
rate and a
interest rate.
better lender.
Absolutely. This is going to help you to get into the property market sooner under your superannuation, and then down the track we refinance, bring it back to where it should be.
That sounds good. It's a
And
great
Kiran,
opportunity.
on the same note, when doing the refinance, the exit fees from this particular lender, will it gonna be too high and to move into different
There
lender?
can be 1.5% exit fee. We usually discuss that upfront. With many times the lenders give you the option, okay, if you do this, I mean, not in this particular example, but let's say if it's commercial, the client's paying 1% establishment fee, and the lender say, okay, make that 1%, 2%, then we'll let you go for free.
Okay,
So all those options are discussed upfront. If we have to leave in this much time, what it's going to look like.
cool.
Okay.
I think that is it for me. There's a lot to know and understand from the banking perspective, what's going to happen in future. But if any questions, happy to answer at the end.
So we don't have much time. We will be covering Manish ji. I think we'll be covering our part in 10 minutes from here. Then we'll
Yep.
take all the questions, right? Awesome. So what we as prop experts, what we want to see is what are the options we have? Where when we're talking about the new builds, definitely they're gonna be demand on a short term, especially when you look into the new builds. It's more like in outskirts of the cities. If you talk about Melbourne, most of the new lands are like in north in Kalkalo or over the Kalkalo Donnybrook belt, or you go into the Tarnet belt to go to Clyde or even further down there. So one thing is if you are buying in the areas where the land supply is there, you will people will rush and then can increase the supply in those areas, right? If the vacancy rates are too high, stock on market is too high, which is the fundamentals for the capital growth, you may see less capital growth when comparing to the properties in a tightly held pockets, right? So short term, yes, demand for the new build will be high, but long term you may not see a great capital growth comparing to the suburbs, which are pretty good on data. So that's the very first thing in there. Manishi, any
See,
experience?
for the new build, my experience so far, which I can share it from what I have been seeing since 2009, and if you take as an example for Melbourne, if you're buying in the outskirts, what has been seen is that whenever any grant, any stimulus has been announced, developers are waiting, they want to take this opportunity. They will straight away increase the price of the land, right? So as of now, if we feel that we need to start buying in these outskirts just to get the benefit for negative gearing, we're gonna pay a little bit higher, right?
Yeah.
As the new stocks comes in, which will happen eventually, the yield will not be effective, right? So we need to think just not from the negative gearing point of view. We need to think from the longer perspective where we can make money, right? The
Yeah.
whole idea is that we are investing. We are investing to create wealth. We're investing to create a future for our kids. We want to protect themselves, right?
Yeah.
So we need to plan it. But what Dinesh has mentioned, if you buy a new property like a land and build it on where there's not much land supply, yes, in that case, because there's not enough supply of the land, the property can grow.
Yeah. So, but I would also add is in some areas where data fundamentals are very good and there is a limited land supply. For example, we have seen people doing home and land packages and new builds in Perth market. We have seen in regional Queensland markets like Mackay, Townsville, Cairns. we have seen the established properties grown, and those who build new houses has already grown as well. So still there is some kind of pockets where you can target in new builds, but not everywhere. It's you're not like you can just think of, okay, the new builds have a negative gearing, I'll build a house now. You may struggle down the line. So that's our take when talking about established properties where we are buying. So we have done more than 400 purchases in the areas where data is strong. They are generally very tight pockets where there is not much land supply left and a lot of new houses. They can't be an option to build a new houses, right? So for example, if someone have a desired location closer to the city, right? And data is strong there. There is no land available. There is no new builds coming in that area anyways. So prices will definitely grow in those areas. That's our take. Slight drop because there is bit of a noise and everyone is fearful that what's gonna happen. But still there are owner occupiers in the market. There is still SMSF purchasers in the market. Those who are buying in a trust structure was not worried about negative gearing at all. There's still all of those people in that established markets. In my opinion, this time will create some sort of opportunities, but eventually, fundamentally, it will still grow. Manish, bro, anything want to share on your side on this?
Uh, if we go into the ground and see what has happened within a week time frame, right? Uh, when we were calling the agents to see what's happening, what we are hearing is that now a lot of investors, a lot of owner occupiers, they want to hold the property, which means
Yes.
in the established properties, the number of properties of the stock will reduce, right? If the
Yes.
stock gonna reduce and if there's a demand, definitely it will push the prices up.
Yeah. I was fundamental. We were talking to a lot of agents at the moment. Everyone is saying, for example, I'm selling my property. I don't have a need of funds. I'm just selling for to buy something else. They have kind of tried to hold themselves now because they won't be able to claim the capital gain tax benefits like before. Plus, there is no negative gearing available for them if they buy the new asset. So that is reducing the stock, and it's wherever we were struggling to find the stock, it's even hard now,
Harder now.
right? Yeah, so next part in here, what I'm talking about is high cash flow. There are multiple ways you can target high cash flow. One is myself, I've just got approval to build a rooming house in Veriby. So that is one product where you can have a high cash flow. There's dual occupancies there where you have two tenants side by side. You can put a granny flat at the back. That's another option. Airbnb, I'm running three properties already on the Airbnb. So again, the revenue in the Airbnb property is not very stable. You can make like $5,000 in a month, and the December month it can be like $12,000. So the revenue varies, but in the end, you get a better cash flow when comparing to the long-term rental properties. Again, every location is different. Every like there need to be special locations where the demand of Airbnb properties are, but that's one option as well, right? Manish, you want to share anything on that?
Now, you mentioned about the high cash flow, Dinesh. Great points. There are multiple asset class. Now, after the budget, what's the right strategy? That's the biggest question which is coming up. If we take backward, right, and if you look backward and think about before the budget, and if someone has a budget of 1.1 mil, 1.2 mil, what can be the best strategy, right? I have been always been advocating like if someone got a higher limit, they should invest into a smaller chunk and buy established properties. But that was one of the strategy which was got implemented, and I have written a couple of posts on PFA. Now with the budget, because we need to adjust, one of the things which I was on like Dinesh and myself and Profox, but I'm always thinking about it. Now, if we got a budget of to spend 1.2 mil, 1.1 mil, why not go into the high cash flow properties, rooming house, dual lock, commercial, Airbnb properties? Why? Because the rental yield will be higher, right? With each budget, we are like, whatever the changes or whatever the announcement has been made, we need to adjust ourselves, right? So
Yeah.
if we got a higher budget in terms of dollar, high cash flow will be perfectly simple. But if we go backward and think about it, hey, I only have 500 to invest. What should I do? In that way, we need to do a reverse engineering. In 500K, what can we buy? Can we buy newly built? Can we buy high cash flow properties, or can we buy established properties? And then we need to start ruling it down where what we cannot buy. And then
Yeah.
we need to go into a location where we can buy under 500 or close to 500, and then see what are the options.
Yeah.
So we need to do a
So
reverse engineering.
yeah, see, 500 won't let you buy the new unless you go units or townhouse. Townhouse is maybe even hard, right? So we are still buying a lot of properties around 500K mark. So only option you have left is established properties, basically, right? So next two options, what we are discussing here is SMSF and commercial. Both are exempt with all these changes came to the budget 2026. That's where we see the opportunities going forward. We have bought a few properties like with 15%, 15 years of lease left, national tenancies, giving you 7% net yield. That means all the outgoings are paid by the tenants. So that can be an opportunity going forward, looking into the commercial properties. Also, SMSFs, when we did numbers with a lot of clients, when you see just take a 7% inflation growth, what we see in the properties throughout the last decades, you will always outperform, most of the cases outperform than the industry super funds. So that is an opportunity to look into that. If you're sitting with 100K, 200K, 150K balances, there might be an option to look into SMSF and a commercial. So I have combined both SMSF and commercial. I bought one property under SMSF and it's a commercial product, right? So basically, these options will open up in the future. So a smart way to buy properties, in my opinion. Manish, you want to share anything?
No, you have already covered up, so I align with you.
Awesome, great. So that was literally giving you a bit of idea. We are happy to help you. We are developing some services where we can help you set up a Airbnb. We are developing some services where we can help you building the rooming houses or multi-tenancies. So reach out to us if we've been through all that. We have done all that. It's not like we're just we were all prepared and doing that already before this budget announcement. So reach out to us if you need any help in there, right? Next, what's our opinion? Before jumping on the opinion, I'll just quickly go through a negative gearing cash flow just to give you an idea. So if you're buying a 700K property, can you see my Excel sheet, Manish, bro?
Yes, I can.
So if I'm buying a 700K property and it's returning me $620 a week, which is generally we get in few of the markets where we're buying, you're getting 4.61% as a gross rental yield. Now putting all the expenses there, let's say you are with a 20% deposit, your total expense is around 190K, right? In that particular case, after considering the property management fees, after considering the rates, after considering the repairs, everything and the depreciation, in the old rules, you're gonna be $13,000 negative overall, right? On top, you add the depreciation and you claim all those taxes. You get some tax back, and your net cash flow for that particular year is 6,700. But what's happening now? Whatever is 13,000 and 5,000 depreciation, there's a $18,000 carry forward taxes losses. That is that correct, Kankur? Right? And every year, for example, the next year your cost base is same, your rent goes to $660. That grows, right? Now your losses reduces to say 16,500. So they actual loss is 11,500, but you are adding a depreciation on top. So all these losses say added in here, and say in 4 years, just a random, you are like 70,000 negative. From there, it's net cash flow neutral, and you're trending into the positive territory where you may start paying the income tax if you're already like over the depreciation as well. So, right? In that case, you're not paying income tax because your trust is your property is already negative geared, right? Those losses will go zero first, then you start paying the income tax on any income you're making. In between, if you sell your property, whatever your losses here will be also considered in a capital gain tax. Is that correct overall?
Yeah.
Right now, I'm just comparing. This is a normal purchase you do in SMSF. If you go like a 106% LVR, means you're getting equity out. So these numbers gonna be a little different. So again, we can help you run all these numbers, how your numbers gonna look like when you buy any property. So reach out to us, we can help you calculating that. But now, if you're switching to the high cash flow strategies, what we say, that's the exact number I'm putting. We bought a client a property in Swan Hill. That's a massive pets domain commercial property. We bought that property for 1.52 million, and that property was renting 104 net. So every expenses was paid by the tenants. you're only paying the land tax and bit of property management if you want a property management in there. So that particular client has no property management in the property because there was direct tax domain paying the rent to them. So they haven't, but I'm still considering that 5% property management is there. These kind of products are positive cash flow day one with the 20% deposit. Even I go like 106%. Like you got an equity out, you have a 300K sitting into your residential property before or owner occupied, you get that money out and you put that money into this. And I think, Kiran, if I'm not wrong, we have that lease doc lendings in the commercial as well, where literally if the rent is around 7%, they don't even look into your borrowing capacity. Is that correct?
Correct. You can go lease doc only if the rent plus 1.5% you can cover there. But you can also,
Yes.
like you said, 106%. If you doing a commercial property and you got equity in the property, you can borrow 100% as well.
And that equity which we release, Ankur, is that because commercial asset is exempt from the rules, is that something I can still claim the negative gearing on that equity release?
Yes, so as I said, commercials are exempt, so there's no need to defer the losses. So you can offset the income in the year it's generated. Sorry, the loss in the year it's generated.
And also from the equity which I release from the other assets. Is that correct?
Correct. Provided that equity sits as a separate loan against that asset.
Yeah.
Then yes,
Right.
just deduct.
And
Yeah.
in that case, these properties are still positive cash flow from the day one. You adding an asset which is growing with the inflation and positive cash flow on the day one. On top, I'm doing this rooming house which is going to be cost me 1.32 million, and we are conservatively looking like 2,700 rent because the 9 bedroom 300 on average rent. After putting all the expenses, this asset with the 20% deposit is still positive cash flow. Even though I go 106% in here, use my equities, we are not sure yet where the rooming house will classified as. Is that classified as a commercial property or is it classified as residential? We still have to clarify that. But considering these properties, they are positive cash flow on a 106% LVR as well. So there are still a lot of options. If you are okay managing your cash flow, there's still established properties as a good opportunities. But if you're not okay with do you want a high cash flow, there are options. And we are going to do a detailed webinar. Me and Manish will be discussing how the layout's gonna look like, how the Airbnb layout property is gonna look like. We can cover all that for you and give you that sort of perspective. That's gonna be our next webinar very soon. But yeah, in the end, Manish, bro, what do you think about whatever the changes in the budget? What's gonna happen?
See, there is some panic to be in. That's a real thing. People want to understand what should be the next step. A lot of questions are coming on a PFA that they should start selling the property. If that's the thought, my solution would be please don't do it. Property is not like we should sell it with a panic mode, right? We should hold it as long as we hold it. Reason, if we sell it, what's gonna happen? We will take the profit and we're gonna reinvest that profit somewhere else. And it's going to be the same story. So why should we sell it off when there is no need? So this media, this news is just a temporary. We will adjust over the time. Now, in terms of the strategies, in terms of why we should buy, right? And that's very important. Investors will not stop. They will still keep on buying. They will adjust themselves. At this stage, given the interest rate is higher, not the budget, I'm going to repeat, interest rate is higher. We saw 3 rate hikes in this year. Suggestion would be we should tap onto those locations which are giving us a high yield, right? It can be just a residential property or it can be any other high cash flow property if our budget allows, right?
And I would add in here is don't go in a very risky markets. Do your risk assessments. You can get a 9% entry yield in residential property in Kalgoorlie, but it comes with a bit of a risk. So basically, you have to see that don't go in very risky market if your risk appetite is not that big. If you are having a risk appetite, you want to go in that risky markets, then we are not buying in there, but we can give you a bit of opinion on that as well. So that's that. And again, we already touched base that the stock is going down because people are holding. Rent can go up because if there's no investors, less investors in the established markets, they will go high. We were buying properties 4 years ago in 380K, say in Perth, getting like 450 rent. That was normal at that point. 6% rental yield drops to 4.5%, 4% at the moment. that can go up on the other side when there's no buyers, there's more rent coming in, then there is more rental yields. Then it's a cycle keep going on. I've done a video that in few decades properties start like in like 1970s you can still buy a property for 30K, whereas we are sitting at like $1 million price marks at the moment. So the properties won't stop because there's a lot of money printing happening, there's inflation going on, everything getting expensive. So that is our opinion overall. I think it's a very short thing which we will cover that in our website now. Manish, we want to touch base on that.
I think we are over the time, but just if you can open up the website. So we are talking a lot about CGT. What should be the rules? If you have bought a property before the budget, if you have sold the property before the grace period, or if you do a purchase and sale after the grace period, which is 30th of June 2027, how does the CGT looks like? So it's the initial phase, as Ankur mentioned in the beginning, that there's a lot of permutations and it can give us a headache. Yes, while we were running this permutation or while we gave this job to the developer, there were a lot of combinations. So we took a basic like this. We need to start with someone as we took the basic scenarios and we built up this particular calculator. It's on the prop expert. Few tweaks has to be done, but on a high level. Or if you look over here, if for example, if the purchase date was and the sale date was before the budget date, right? And the property was bought for 500K, estimated prices is 1 million, which is like it has gained up by 500K. So if you scroll down, Dinesh, it falls under the scenario where the 50% CGT will apply, right? Yes, at this stage, we haven't considered the acquisition cost, selling cost. The calculator will be refined in a week. We will consider that one. But if we change the values, Dinesh, can you go upstairs, go up? And in the purchase date, make it 1st of July 2027. 1st of July. Make it 1st of July 2027. And okay, by default, it has made us 42, but we can change it. So this is the day when the property has been purchased after the grace period and the sale has happened afterwards. So if you scroll down, the scenario 2 will kick off and it will calculate on the base of the cost-based indexation, right? So scenario 2 is on the bottom, Dinesh. So it will show you how the CGT will look like, right? So this tool can help you out just to understand what your CGT would be. Scenario 3 will be the mixture. If we have purchased a property before the budget date and selling after the grace period date, how the CGT will be. It will be a combination of 50% till 30th of June 27, and after that, it will be indexation, right? So that's something which will help you guys. Just small tweaks needs to happen. We will fix it.
We are working on that. You can just go into Prop Expert's website. Again, the actual calculations do we do with the accountant? They are just for general calculations only. So that's pretty much it. We'll open it for the question answers. Thank you everyone, especially Ankur and Kiranji, to giving a great presentation. We have Farhan raising the hand, very first one. Please go ahead.
Thank you, Dinesh. So I want to ask, what's the best structure moving forward?
Ankur, you want to answer that?
Yeah, it's a tricky question.
It's probably the main question right now.
Main question, what do I do now? So I think it all depends on your individual circumstances because as Dinesh touched earlier, the property that you're looking at, what the cash flow looks like and what does that mean to you. So whether it was going to be positive anyway, so is there any harm in then buying under your personal name? Probably not. Or whether you can buy the property now and wait for it to become positively geared, and when does it become positively geared, and then can you wait and then manage your cash flow, or as a protection is still more important to you, so regardless of the tax. So then that means you could still consider trust because that still gives you that. So I think there's no one set answer to this question. That will depend on your individual circumstances. So you probably have to sit down with your accountant to work out what exactly you're trying to achieve, and then from there you start filtering out what won't work, and then you'll be basically left with what does work.
Uncle, can I add something over here? I'm not an accountant, so I will say the answer in a different way. I can share my experience, right? I have properties under my personal name, under the joint name, under the family trust, unit trust, and the company, right? All the structure has been aftershored. Now, whenever we buy any property under a particular entity, the whole idea is to minimize the tax, right? My learning is that whatever way we try to do it, in the end, we still have to pay tax. We can't avoid that, right? So if you are in the low income earner, right, then yes, you can play around with these things. You can save some on tax. But if you are already on 45% tax bracket, whatever way you do it, in the end, ATO will still be behind you. They will ask for the tax, right?
Yeah.
And
See,
I'm going to add my perspective here as well. If you are in the low income bracket, then that means we may not be able to go under trust, or actually, I'm still talking about in the past. It's not going to make a difference anymore. I have to get that out of my head now.
Yeah, see again, very like I've been like helped we like there's a lot of young professionals we helped with like say single earner or like under 150 200K. We used to buy a lot of properties in the trust. There was bit of lenders when the properties trended the positive cash flow to ignore the debt and then buy the next one. So that I think trust is still there, SMSF is still there. There's new discussions about company because of the 30% minimum tax now on the trust structures. The company can be the new thingy. So we can be covering in the next few sessions in there. But it's really depends on your personal circumstances and your goals. Like we have bought 5-6 properties for those mom and dad investors, which they can't buy if they buy under personal names. So just have a good discussion with good accountant and a broker and how to strategize. We can help you in there. Right.
Let's
Okay.
jump on for the next one. Who was the next, in the queue, or you just pick up and
I think I've seen
BSK Singh, I think is the next one. Yeah.
Hello, everyone. I just want to know what's the cost of setting up SMSF and what's the regular cost we have to pay to run the SMSF, and what kind of property should we look to buy in SMSF? So, 3 questions, yeah, please, if possible.
Okay, so I answered the first two, and I think Manisha Dinesh can answer the last one, which one you should go. So the setup costs, basically, if you're going to borrow in the SMSF, so that means the bank's requirement is you must have a corporate trustee. So then we have to set up a corporate trustee and the superannuation trust. That generally cost around $2,000 mark. Then because of these lending rules, we have to have a bare trust and a bare trustee, and that generally also cost about $2,000. So all up, I would say about 4,000. That's the upfront cost. The running cost depends on how good is the accountant. So there are people who do the whole accounting and audit for $1,000 because they send it offshore. But generally, if you go with a decent provider, that's sort of like around $2,500 mark. Then you have ASIC, $67 on the one company, $329 on the other company. Then the ATO, $259 on the supervisory levy. So all up, I would say budgeting about $3,000 for the compliance running costs each year.
So just in a nutshell, like $4,000 to set up if you're having a lending in SMSF.
Yes.
Some people they have, like, for example, I've been to a scenario, someone had 700K in super, they didn't do any lending, they bought outright in the super. In that case, you don't need a bare trust. So in that case, you're only creating one SMSF that costs you 2,000. If you're getting a loan with the property, then you're adding another 2,000 as a setup cost, is a $4,000.
Correct.
The ongoing cost is audit cost, which can vary, say 1,500 to 2,500, accountant to accountant, plus all the ASIC fees and stuff. So basically $3,000, as Ankur said, is ongoing cost, right? Ankur, just a question here: if you have two properties, is it the same audit cost, or audit cost? There is two different bare trusts in that scenario, but is the audit cost same?
Audit cost is same. Accountant, like, if I have to do the account, so if I charge, let's say, $2,000 for one property, for second property, it doesn't become 4,000. It's just marginally goes up maybe by a couple of $100, if that. So because the basic structure is still the same. And again, depends on how good the client is and how good you providing the documents and how many Panadols I have to take before I send it to the auditor. So generally, yes, it doesn't add significant cost.
Sounds good. We have Narinder here. Is that answer your question, Singh?
Yeah, yes, just one last one. What kind of property should we look to buy in SMSF?
Okay, Manish is I can answer that question. So we are trying, like, one thing is where we are dealing is mostly established properties. When you go a brand new property in SMSF, the problem with there is you need a one part contract. What it is every someone has to fund the whole project, and that adds another 50, 60, $70,000 depending on the overall cost.
It can be even higher. It can be
Even
even
higher.
more.
So we generally go with the established properties. We try to be like a high cash flow property so that you don't burn a lot of money under SMSF. Generally, if your budget allow, we don't prefer very old properties. If your budget is around 500K mark, there is not many options in diverse economies where you can buy a brand, like not brand new, like new, like 5, 7 years old house. But if you have a budget of 750K in super, we prefer not buy like at least 2010, 15 build plus properties. So like you can buy a SMSF in commercial space as well. That's what I've done. A commercial, I bought a warehouse in Epping only in 480K. So there's multiple choices you have, and looking, Manish has done. Manish, you want to share your experience on SMSF?
Just to add on that, we also need to consider what's going to be your employer contribution, right? So, and why I'm saying is that let's say as a husband and wife, their employer contribution is 25K per year, and you are buying a property which is negative by 25, 26K. That will give you unnecessary pressure, right? So your out of negative component should be lower than what as a husband and wife are contributing to against that particular super, right? So that's going to be another thing needs to be considered.
Yes.
Right. Let's
So,
go for the next one.
So sorry, can we buy in a metro or regional? Doesn't matter in
Doesn't matter.
SMSF?
Doesn't matter.
It doesn't
If you
stop
go
you.
very regional, some lenders will restrict you for lending. They would say you need a 70%. We will lend you only 70%. You need a 30% deposit. But majority of the cases in metro pockets, regional hubs, you can easily get lending at 20%. Then for 10%, they might be very specific metro pockets, which Kiran can answer in the future if you want to reach out to him. To her.
Thank you, everyone. Thank you.
Yeah.
Let's jump to the next one.
Narendra?
Sorry, this question probably is for Manish. So new rules, CGT and negative gearing doesn't apply to grandfathering. That means any property purchased before that night doesn't apply. So I think recently you said the capital gain tax is only if I sell that property before July 2027, then 50%, otherwise indexing. Can you please clarify those one?
Yes, this is my understanding. The CGT, we have to pay CGT. It's a method which will change. So till 30th of June 2027, the method will be on 50%, right? Post that, it will become as an indexation. So on 30th of June, if you're holding a property and you're not selling it, for example, or you're selling it on 1st of July 2028, so on 30th of June, there will be a valuation of that property. That valuation will be used as a base to do the indexation.
Okay.
Right. So before that, it will be 50% CGT. Post that, it will be a indexation based.
So that
Am I right? Am I right, Anko?
Yes, spot on. So there's two calculations. So as Manish said, you find out the value at 30 June, compare that to your cost. So that's your gain, number one, you can call it, and 50% discount applies on that one. Then that value becomes a cost base for the period after 30 June 2027, and then you compare with the sale price and with the indexation applied to that market value. So then you will have gain number two. So that's how it will sort of work out.
Right. Okay.
So the actual puts formulas, and they said they will come up with a simple calculator where you can put the figures, and then it will work out the tax for you.
That means all the property owner has to have the property valuation if they want to hold.
Yeah. Yes.
Pretty much, yes. Yeah.
Thank you.
Cool. We jump on the next one.
Pratik, you want to ask a question?
Yep. Thanks, Manish. Thanks, Dinesh. Thank you, panel. Few questions actually. One is for Ankur regarding the SMSF. So when we are setting it up, if I have one SMSF that got two bare trusts underneath, one is for the lending, another one for the company. So now, if I want to buy another property, can I use the same SMSF trust and just create a bare trust underneath, or it has to be just totally separate?
Yes, so basically, when you did the first one, you basically had four structures. So one was your super fund trustee company and the SMSF itself. So there's two. Then the third one you have is a bear trustee, which is holding the title of the property for your property one, and then the bear trust that sort of ties up all these entities into one document. When you're going to buy the second property or even third property or even fourth property, you can use the same bear trustee company as a title for all the properties. You only need to create that fourth structure, which is a bear trust that defines that relationship. So that means your three entities can remain the same. Only the fourth one will be the new one each time you do a purchase.
So that new one will be holding the property
No,
asset.
the asset is held under the bear trustee company because that company is on the title, not the trust. The trust is just the bear trust that sort of holding it for the beneficial ownership of the super fund, but the title itself is registered under the trustee name. So the second the property you can also be purchased under the same bear trustee company, but we will have a new bear trust that defines the relationship for the second property.
So the lending will be again with the first company then, whatever the PTY Ltd we have created. So the lending will be so the same company is going to have two lendings basically for each bear trust.
Yes, I think Kiran can explain that as well. I think that's how
Yes,
it works.
you cannot hold the properties under the trust because it goes on separate bear trust, but the lending is yes.
Yeah.
Okay. All right.
Yeah.
Thank you.
Just to explain very simple way, we have one SMSF in my personal case. Then I have two bear trust under the one SMSF and two different assets. I can have the same SMSF buying another property, can create another bear trust. Is that correct, Ankur?
Yes.
Right. And I have seen people, Ankur, just a question to create another SMSF as well. Is that another option available where if you want to do a purchase with someone else or, having a totally different SMSF setup, that possible?
Yes.
That's possible too in
Look,
some
that's
small.
possible. You can have 10 SMSFs. There's nothing legally stopping you to create the super funds, but the question comes if you're going with somebody else in the second fund, and let's say the friendship breaks down and all that, then what happens? It's not going to be so simple when we have unit trust where units can be transferred and asset can be continued to be held. So if one member says, "Hey, I want to be out of your super fund," you can have fun and keep it all yourself. It's going to be a big mess. That pretty much will mean selling the asset to pay out that member balance.
Yeah. Just adding in here, we are over the time, but we are still taking question for next 15 minutes before we shut down. Pratik, any question?
Yes, one more question, sorry. Considering, I know it might be a bit too early to answer this, but considering what's happening right now with taxation, CGT and whatnot, the properties that we are currently holding as investment properties, because down the track, negative gearing is definitely going to change. So is it a good idea to hold those properties rather than selling them off if someone is planning to sell off the properties from the CGT perspective purely?
Pratik, I think I did answer it earlier. We will also have a chat over the call. I know which Pratik is this one. But my saying is that why should we sell a property when we don't have a plan? If we have a plan, and what would be the plan? We sell it. Where we're going to bank that money, right? At the age bracket where I can say most of the people who are in this call, they are under 50. What's going to be the plan if we sell the property? We need to reinvest. Where are we going to reinvest? Outside of real estate? If we think about to invest outside of real estate, let's say cryptos, shares, gold, and I'm sure Ankur can answer me as well. The CGT rules has also changed for those assets,
Correct.
right? So what are we in for? We have to adjust. We need to adapt that wherever we're gonna invest, the CGT rules will applicable, which will be in the new form, right?
Yes.
So going back, what is the real need to sell it?
Yeah. And I would say long term, these assets gonna grow anyway. So there is no panic selling is the last thing you should do, in my opinion. And you might see a capital growth pretty good in coming years as well. So like we have seen where we are buying properties, the only difference is there used to be 20 offers on the table, reduced to 10 offers on the table. But there's still 10 buyers on those properties. So good assets won't stop growing. So if your asset in a very good pockets and fundamentally strong, I don't think so you have to sell your properties.
And also, just be mindful, these rules are not for the lifetime. 2 years later, they can bring it back.
Yeah.
When things don't go forward, then you don't want to regret that. Oh, wish I knew they're going to change it. I wouldn't have sold it. So,
Awesome. Yeah, true.
Thank you.
Great. Next one is Deva.
Yeah.
What to liberal?
Yeah,
What to liberal to get out?
Hi, I'm Debabrata. Thank you for everyone. So I have a quick question about the CGT for the franking credit. Like if I purchase a property under trust or company, what will happen when I wanna sell like after 10 years and wanna cash out? Because in company we are paying 30% tax. So and then after 10 years if I sell and wanna cash out, so do I need to pay tax again or it will be franking credit?
So I think you're mixing up with the revenue gain versus the capital gain. So when you have the property for 10 years and the company is driving rental income minus your expenses, then you're paying tax on the profit that's generated by the company, which is a revenue income, normal income. So when you sell the property, then that's a capital gains sort of calculation, so which is completely different to what you've been doing for the 10 years. Same as when you have property under your name, what you've been claiming is negative gearing, but when you sell it, then there's a capital gains tax calculation, which is completely separate to what's happened in the last 10 years.
Now, my question is, what will happen after 10 years when I'm gonna sell the property? I need to pay 30% CGT in company, right?
Yes.
And then if I want to take out that money and put under my name, do I need to pay tax again?
No, so the way it will work is, so the company pays tax on the taxable gain that's generated, then you as a shareholder pay yourself dividend, which will have franking credits attached from the company rate. So that means the income gets taxed in your hand, but then you will have franking credits to claim against it.
Then what's the difference in trust in terms of CGT?
The trust will have to pay the distribution down to the beneficiaries, but with a minimum 30%. That's the change in the trust. So you could be, earning at 20% marginal rate, but if the distribution comes from the trust, that will still be taxed at 30%.
Okay, so because nowadays a lot of people are saying like trust is dead, company is better, but I didn't get it. Like why company is better? Because for me, it feels like same basically.
There's pretty much about 5% difference because companies generally at 25%, so the trusts will go at 30%. So this is where they're probably talking, and I don't know, Kiran might explain a bit more whether from lending point of view, companies will work better from the bank side of things, or trusts are still better.
With trust, we have been able to ignore a lot in the past. With companies, it may or may not be the option.
And my last question is there any lifetime of the trust or company? Like if we want to keep it and want to pass to the next generation, can we just add them or we need to sell?
Look, the trust will have automatic inclusion of your immediate family as a wide definition of family trust. Companies generally not, because you have the shareholders, and if you change the shares or you sell the shares to or transfer the shares to your kids and all that, then there might be CGT implications because the value of shares would have gone up if the underlying assets have gone up.
Thank you, Uncle.
That's all.
Next is Karan.
Dinesh, let's watch the time as well. So we call out for three more.
Two questions. I think we take Karan and Amol only, and we just shut down from there.
Yeah, but before we take the question, I want to request each and every single person. The great presentation has been given by Ankur, Kiran, Dinesh, and myself. We are professionals, so sometimes it's good to say thanks to the people who are in this panel. Their Facebook page, their details will be shared in the call, which has already been over here. If you are the Facebook user, please go into their business page, like it. It's a way to say thanks, right? So that's all. That's for me. Dinesh, continue with your.
Karan, please go ahead.
Thanks, Manish. I was going to say thanks anyway for the great presentation. My question is, if there's a new build, let's say I bought a house back in 2023, it was a new build. would there be negative gearing on that one? Would it be before 11th May? Would that rule apply, or would that rule not apply?
So if you bought before the budget night, it doesn't matter how you bought it, whether it was house and land package or you built a new house or you bought an established property, the property was there and was purchased before 12th of May 2026, then the grandfathering applies. That means you continue to claim negative gearing as is.
Okay, thanks.
Yeah, the new rule only comes for the newly built after the date of 1 July 2027, when they're saying, okay, if you now want to claim in the year you have negative gearing and you don't want to accumulate losses for the further years, then it has to meet the definition of new built.
I have a very, very creative question here, Ankur. So now he has bought a new build in 23. Will that be considered as a 50% discount, or will that have an option of choosing either of indexationers or 50% discount, or he can only get a like a 30% indexation method?
In my view, it will be a mix, depending on when does he sell it. If he sell it before 30 June 2027, then yes, 50% discount. If it's after, then there's two-stage calculation.
Yeah, sounds good. Awesome. Anyone else left? It was Karan, right? Karan asked the question already.
There was one more person, I think he had a
Amol, yeah.
Amol, yes,
Hi,
Karan.
everyone. This is Amol Puni this side. So I think this question might be for Kiran. So I'm a self-employed, and I was looking through my super fund last week. Being self-employed, like I contribute very less to my super. I should have done more, but that's the last step. So I realized like I've only paid $9,000 in this financial year, and pretty much same last financial year. So how does the banks or the lending institutes assess in case of super? My wife, she's a government employee. Her is a regular super. And is there a way I can, if I need to borrow for SMSF setup, to borrow for buying an investment property, how I can get more borrowing?
Yes, so low doc is possible for superannuation as well, and in fact, it's much easier as well. All you have to do is get your accountant to write a letter what you will be contributing in future, and the banks will take that income.
Right. Cool. Yep. I mean, just be reasonable. Like if they assess like 10,000 may go around 15,000, like something like that, or like a
reasonable income. Well, it can vary a lot for the self-employed, depending upon how your business is performing as well. It will be mainly between you and your accountant, and also you also have to be mindful of the calculation, because at the end of the day, there's a rent, and then that money is also required for you to make ongoing contribution to make sure you're covering the repayments as well. So you can just basically, let's say your wife get 20,000 and you contribute 20,000 ongoing in future, as long as there is a letter available, that is possible.
So when you showed the example of one SMSF loan setup, there was 8.5%. Was it the low doc one, or was it just the general?
No, this is higher rate because of the 90% LVR. The preferred LVR is 80%, but in case there's a low balance, 90% can be done, and hence the extra 1% interest rate in there.
Okay, now we won't go for 90. I mean, like around 80%, maybe 70%.
If it is 80%, it will be a different product.
Okay.
You might still sit in the higher interest range though, because of the low doc accountant letter only. But again, it will be a different product, not this one. It is definitely possible, and many self-employed people choose to go that path.
Perfect. Now, thank you. Thanks a lot. Thanks, Manish and team. Great presentation by all of you.
Thank you, Amol. Great. Thank you, everyone who has joined today. It was really good time. Almost 2 hours we have spent today together. So thank you for being with us, asking great questions, great conversations. Again, we are always here to help you out. Reach out to us. Our numbers was on the screen. So call us directly. There is calendars on our website as well. You can just book a call with us through the calendar as well, and would love to chat with you. And keep investing. That's the whole goal. Keep investing. Don't go with the small hurdles coming in the way. Look at the bigger picture, long-term growth perspective. So you will always do good, in my opinion. So anything you want to add, Manish, bro, before we wrap
The
up?
key, yeah, the only thing I would say is that with every change, we need to learn how we can adjust, right?
Yes.
If we can adjust ourselves, there's nothing we can stop us.
Awesome.
So that's some.
Anything from you, Kiran, before we wrap up?
Don't panic. No stress selling.
Awesome. Good. Ankur?
No, nothing. Just have a nice dinner and go to bed. We'll worry about that tomorrow.
And get into your SMSFs. Call Ankur straight away. We are here
Yes.
to help you buy a property.
That's right.
Awesome. Good. Thank you, everyone.
Thank you.
Thank you.
Good night,
Thank you.
everyone.
Have a good night.
Thank you. Yeah.